This equal weighted ETF has outperformed the S&P 500 for the past 20 years. This ETF, RSP, has returned investor 469.6% over its lifetime. Over the same period, SPY has only returned investor a 348.9%. And as you can see, RSP has gone up more during the bull market and pulled back less during the bear market. So what is the SPY? So the SPY is one of the biggest ETFs in the world. It tracks the S&P 500 index, which is composed of the top 500 companies in the US market by market capitalization. So on the other hand, what is equal weighted ETF like RSP? So the equal weighted ETF like RSP will pick the market leader in each industry and use equal weights to distribute the funds. For example, if there's 10 stocks in this equal weighted ETF, each of the 10 stocks will weight 10% in this ETF. You will have more shares of the stocks that has the lowest stock price, but overall it's based on the invested amount. So the major difference between RSP and SPY in terms of strategy is that SPY is weights holding based on the market cap. So right now, Apple has the biggest market cap. That means SPY will hold the most amount of Apple stocks based on its weight. On the other hand, RSP will give equal weight to all 500 holdings. Regardless of the market cap, if RSP holds 500 stocks, all 500 stocks will have an equal weighting in this ETF. In terms of numbers of holding, one is 504, the other one 503. No major difference. In terms of expense ratio, SPY is at 0.0945% and RSP is at 0.2%. So RSP's expense ratio is almost double of the SPY. In terms of asset under management, SPY is one of the most traded and one of the biggest ETF at 381.5 billion, whereas RSP is only at 1/10 at 32.4 billion. In terms of the dividend yields over the 12 months, SPY is at 1.57% and RSP is a little bit higher at 1.84%. And in terms of the top 5 holdings, you can see that based on the market cap, the S&P 500 holds 7.48% of Apple, 6.68% of Microsoft, and on the other hand of RSP, the top 5 holding is the same top 500 holding at 0.27 or 0.26%. So these are some of the advantages for equal weighted ETF like RSP. So first, the equal weighted ETF will help you buy low and sell high actually. So the ETF was started with equal weight throughout all the stocks they're holding. So if the stock price go up in that ETF, the weight of that stock in this ETF will also increase. And vice versa, if the stock goes down, the weight of the stock in this ETF will actually go down. For example, if this ETF holds 10% of Tesla and Tesla goes up in price, it might become 15% of this ETF is holding Tesla stock. So the fund manager will actually go and sell the extra 5% of the Tesla stock in this ETF and take profit. Whereas the traditional ETF will continue to buy more of Tesla stock as it goes up and try to cut losses on other stocks so that has the money to buy more Tesla. This means that the fund manager will buy more of the stocks that has gone up and continue to chase it all the way to its all-time high. And we all know we want to buy low and sell high in the long term. So the equal weighted ETF will go buy more of the sectors that are strong, but just at the moment have their money rotated out to different sectors, so they buy at the low point. So does the equal weighted ETF only choose stocks with high dividend? And the answer is no. Equal weighted ETF focus more on the stability of the dividend payout. For a stock to be qualified for the equal weighted ETF, this stock has to continue to pay dividend for the past 3 years. And when a company has been paying dividend and increasing their dividend for the last 3 years, usually means that they have a higher net income over the last 3 years. And a lot of times these stocks in the equal weighted ETF does not pay the highest dividend with the lowest amount of growth, or pay the lowest dividend with the highest amount of growth. A lot of times it's actually in the middle. So we get the both balance of dividend and the growth. And also another advantage is that you don't have to worry about when to buy or sell an equal weighted ETF because it's been balanced twice every year, and the fund manager will help you buy low and sell high. As the stock goes up, it will take profit and continue to rotate to the stock that has been lagging in this ETF. So that's why in the long term, the equal weighted ETF could be good for someone who likes the dollar cost averaging method. Now, RSP does come with some disadvantages. And you might also be wondering like me, what if the stock continued to rally and the fund manager took profit too early and missed out the entire rally? So not only the equal weighted ETF is rebalanced twice every year, when the fund manager take profit of the stock that has gone up a lot, it doesn't mean that it sold everything. It only sells up the percentage that has gone up and it turn it back to the equal weighted. The fund manager only sells enough stock to adjust it back to the equal weight. And it does not mean that all the stocks are being sold. And even a good stock does not rally all the way up. It usually rally in waves, as you can see in this chart. So that the equal weighted ETF will be able to capture the rally and then sell at the top and wait for it to pull back and get back in more and then get on another rally and then do the same thing on and on. And now you might be wondering, Cody, we're still relying on the fund manager to pick stocks. And that's right. So a lot of the equal weighted fund managers work with stock picking companies. And usually fund managers work with index picking companies. So they set up their criteria and just pick out the companies that fit the criteria. Now, another disadvantage is that RSP has the expense ratio, which is twice of SPY. So you're giving away a little bit more profit than you actually make. So you're paying twice the amount to have your money managed. In terms of the maximum drawdown, for the last 1 year, RSP has a lower maximum drawdown at 18.5%, where SPY has a higher drawdown of negative 20.25%. Now, if we step back a little bit, in terms of 5 years and 10 years, then the result is vice versa. And in 20 years, RSP actually has a higher maximum drawdown. And you know what's another disadvantage? Making money at 8 to 10% per year still will not replace your income and give you the financial freedom you deserve. So we already provide you with an alternative on top of S&P 500, but if you really want to make a higher return like what we're targeting for 18 to 54% after you learn it, only spend 30 minutes per week, then check out our full case study in the description to learn how. While the SPY and RSP track the S&P 500 index, over the long term, RSP has done better than the SPY. If you're planning on investing in the S&P 500 over the long term of more than 20 years, you might want to consider the equal weighted RSP ETF. Otherwise, you may just want to consider SPY. Say yay.